We're going to tackle everything that you need to know when it comes to divergence trading. And I answer the question, what is the best divergence entry? What is the best divergence indicator? And how do you find divergences? What do they tell you? And why are they so cool? So first of all, let's just take a basic look at the divergence and what is a divergence at its core. A divergence, as the name suggests, it means that the price action and the indicator are doing two separate things. They're not agreeing, so that they are diverging. And here we can see it very nicely. The price action is making higher highs, whereas our indicator, in this case the RSI, is making lower highs. So the price action and the indicator is not agreeing. And this is very important to understand, because when we just look at the price action, it could look like we are looking at a strong market, the market is going higher, we are making new highs, but the indicator is already telling us that the trend is slowing down, and the RSI indicator is a trend strength indicator. And when the RSI is making lower highs, especially like in this case, significantly lower highs, it shows you that the trend strength is going down. The price action is losing strength. And when we take a closer look here at the top, we can see that just from looking at price action. So what are the points that indicate the trend is losing strength? First of all, you can see those big red candles. Look at this trend here prior to this top. It was a healthy uptrend, green candles, very small red candles, and then suddenly, boom, two huge red candles, larger than anything that we have seen in this whole uptrend. This is already a big heads up, and it's a big sign that the market is not as strong anymore. First clue. Then look at this high compared to this high. Yes, the price makes a higher high. However, how does the market make a higher high? Barely. The close from here to here just is very small, or the difference is very small. The market is almost not able to make a real higher high. And in a healthy uptrend, you really want to see that the market keeps making higher high after higher high, and there are convincing higher highs. However, when the price is just barely able to break through, and you can see when we just look at the wick here, the market is not even able to close above the previous high. So we only have a higher high based on the candle closes. And not here, you can see that it is a very, very different picture. And those things lead to the RSI diverging from the price action. So the indicator is picking up clues that we at first glance may miss. So an indicator divergence is very important. And one trading approach, and we will get into different trading approaches, could be a break and retest. So here we have a divergence on our RSI, higher highs here on the price action, lower highs on the divergence or on the indicator, and then the market breaks into a new low, comes back, retests it, and then starts the downtrend. So the big problem that many traders have is that they trade divergences blindly. What they do is that as soon as a divergence shows on their charts, they just jump in. And this is way too early. And a divergence, although it's powerful, it's not powerful enough to just be a standalone trading system. You need to add other concepts and tools and ideas on top of that. For example, a breakout, a break and retest, a multi-time frame approach even, a trend line, as I will show you later, maybe even a moving average breakout. We will get into that later. But, very important, divergences on their own are not strong enough. So, what is the right indicator for a divergence? And the common answers are RSI, MACD, or stochastic. However, those are all momentum indicators. What their purpose is they are all looking at trend strength. So what happens is that they will usually almost always provide very similar signals. So it doesn't really matter which indicator you choose. You can see here we're looking at the divergence that we talked about previously, and all the indicators gave you a divergence. So pick one that makes sense to you. Pick one that you are comfortable with reading. Pick one that you have been using in the past maybe, and then don't worry about it anymore. Don't look for another option, for better setting, for something else, for the holy grail, whatever. Pick one thing, study it, master it, and stick to it. Very important. There's no difference usually in any of those indicators. They are all going to provide very similar or even the same signals. Another very important concept that arises when we come to drawing divergences is that we want to look at distinct swing points. And this will help you have a little bit more of an objective divergence drawing approach. So we want to look at really where's the market making swing low and swing low. Here it would be very hard to find out, okay, where is here actually the swing low, because the market just basically grinded higher. Here's a nice swing low, here's a nice swing low. However, the market made lower lows, price as well, so all good. Here, low and low. And between swing lows, you want to have here such a nice reaction. You want to have a swing point. That's why it's called swing point, because between the 2 points, the market is swinging. And the indicator is then also much, much easier and more objective to identify, or the divergence rather. We have lower lows here, and we have higher lows here. Classic divergence, and then we have a turnaround. A very common tool to use as well is the 20-period moving average. Whether you use the EMA or SMA doesn't really matter, but what you do is that, first of all, you look for a trending market, you look for a divergence, and then you wait for the market to break above the moving average before you try to looking for trades. It can help you to be way more objective in your trade finding process. The 20-period moving average is also a very well-respected tool in general, and you could also use this for filtering purposes, for example. So you look for markets where the price has been trending below the moving average for a certain period of time, so that you make sure that you are actually looking at real trending markets, because one of the bigger problems that many traders have when it comes to divergences is that they look for divergences everywhere. However, they only should be looked for in trending markets when the trend has been going on for quite a long time. That's where you want to look for divergences. As I said, break and retest helps you a lot to be more objective. It also helps you to stay away from this bottom picking. So here we are on a 30-minute time frame. You can see we have a nice trend line. We also have a nice breakout level here, previous swing highs. So we want to wait for the market to make higher highs and higher lows before we get in. We have our divergence here. We have already here the market making higher highs, which is already indicated here by the RSI. And then you wait for the market to break out of this pattern, out of the trend line, out of the high. And then you wait for the retests. They can often be very, very high probability trading scenarios. And it all starts with a divergence, but it doesn't end here. A divergence alone is not powerful enough. I can't stress this enough, but if you have the divergence as the base or the foundation of your trading approach, it can help you find great trades. A divergence helps you put trend structure into a better context. As I said, there are a few things you really need to make sure that are present. One is that you look for divergences in a trending market. The 20-period moving average will help you, because here you're going to have a nice 20 period. The divergence, or looking for divergence, also will force you to look at highs and lows. How are swing lows and highs forming? Do we have a market which is making higher highs and higher lows, or lower lows and lower highs in a downtrend? Here you can see the market seems to be breaking the structure, whereas previously the market made lower lows and lower highs. Now we are in a territory where the market made higher lows here and a higher high here. And then you look for breakouts, retests, and you want to make sure that the trend structure is then still adhered to. The market on a reversal is then making higher lows and higher highs. Combine divergences with a breakout approach. This is very helpful because, again, it helps you to just stay away from bottom picking, which is what many traders do when they look for divergence. They try to nail the absolute turning point, and then they are way too early in. And a much, much better approach is that around a divergence, try to find a pattern. For example, here we have something like a wedge pattern, and then wait for the market to break out. That way you are automatically going to stay away from bottom picking, and you're going with the momentum. You are not really here trying to nail it to the absolute top and the bottom, which is always a recipe for disaster. Or another way could be, again, we use a 20-period moving average, and we are wanting to see the market break the moving average, and also we want to see a strong break away from the divergence. So the market was trending. We have a triple top. This is a triple tap actually, which we covered in a previous video. We have 1, 2, 3 taps, increasingly shallower and shallower. And then if you draw a support level here, you have your strong breakout. Again, you can and you should build confluence around a divergence. A divergence is one signal, one criteria. However, you could add things like a moving average breakout. You could add things such as a support resistance breakout. You could add things such as a break and retest. You could add even a multi-time frame on top of that. And any of those things will help you just build a little bit more of a robust trading system. Obviously, at one point, there comes this point where you just have taken way too many things into account and you have too many rules. So there's somewhere a sweet spot that you have to hit. But just trading a divergence alone on its own is not enough. And I've seen it many times. Traders run into issues. So I really caution you. Divergences are amazing. They are great because they help us understand the momentum of the market. However, on their own, they're not strong enough. But build a few confluence factors around it, and you will end up with a great trading approach.